What's up, guys? Today I want to give you some tips for selling your stocks and how they're going to fall into different tax brackets, because you have two different tax brackets: short-term capital gains and long-term capital gains. Short-term means you hold the stock for under a year. Long-term means you hold for over a year. Now, short-term is just getting taxed as normal, pretty much your normal working income, and that's going to be something separate. But the nice thing is, for long-term capital gains, the tax rates are much lower, and specifically, this is for if you're single. If you're married, it's a little bit different. If you're single, the numbers go $0 to $48,000 of profit for long-term capital gains is 0% tax, zero. If it's $48,000 to $500,000, then it goes up to 15%, which still is not that bad. And then if you're making well over $500,000 of profit for long-term gains, then you get taxed as 20%, and that's still not terrible. Now, if you're married, it's the first bracket changes just a little bit. For that $48,000 or under, now that number changes to $96,000. So if you're married, you can make up to $96,000 of long-term capital gains profit, and it will be taxed at 0%, which is super nice. But either way, the long-term capital gains, any of those different tax brackets is the ideal tax bracket to be in, because it's lower than your normal working income bracket. But the big one for me is that first $48,000 if you're single, or $96,000 if you're married, that first bracket is 0% tax, which is huge. As long as you keep it under that number, you don't have to worry anything about taxes. So those are the tips for today. Let me know what you think, and I will see you in the next video.